G'day and welcome to this week's video. My name is Ashley Rowan and I'm a financial advisor here with Consorting Private Wealth. In today's video we're going to be looking at a bit of a guide for beginners and how they can begin their investment journey. So this video will contain 5 tips to get you started. Now the first tip, and perhaps the most important tip that we've got for people looking to begin their investment journey, it's to start it early on, don't delay it. The longer you are invested, you get to take advantage of compounded earnings, which is essentially earnings that you get from your initial investment capital, but then reinvested to generate their own returns then again. So it has a bit of a snowballing effect. Now to give you sort of a bit of a case study scenario, what that actually looks like, let's say you're saving or putting away $200 every month and then investing that amount. Let's say you did that over a 10-year period. Now at the end of that 10-year period, the balance of your portfolio would be approximately $33,300. Now that's based on a 6% return. Now had you not invested that and just saved that and then just sat in a cash account with no rate of return whatsoever, the balance would be approximately $24,200. So you can see there's about a $9,000 difference there, and that is compounding earnings really taking effect there and making a substantial difference. Now the next tip is to decide how much you'd like to invest. Now at the end of the day, it's very specific to your goals and objectives. If you want to start early and save for your retirement, which may be in 10, 20, 30 years time, the amount you'll need to invest may be smaller portions but more regular over a longer period of time. Now this is in comparison to maybe a young individual saving for their first home deposit. They may have to save a little bit harder and put away larger amounts over that shorter period of time. So determining how much you'd like to invest is very specific to your goals and objectives. Now the next being, you need to open an investment account. So this probably tails on from the previous suggestion where you need to understand how much you'd like to invest and what your goals and objectives are. So as an example, if your objective is to save until retirement, essentially you'll need a superannuation account. And then making ongoing sort of contributions, probably in conjunction with your employee contributions along the way. So if your goal is to maximise your retirement savings, superannuation is the ideal platform for that. Alternatively, if you've got a short-term investment sort of horizon and your goal is to, let's say, purchase a car or put forward a home deposit, a share trading account or an investment account that gives you access to managed funds may be the most suitable option. And once again, alternatively, if you're a more conservative investor and you can't handle the volatility within growth assets, a simple term deposit or a fixed interest portfolio may be the best option there. So depending on what your goal is, then you can start to consider what the most appropriate investment platform or structure will be. Now, once you've decided on how much you'd like to invest and you've got the appropriate structure established, you'll need to determine an investment strategy. So how are you going to track and monitor your investments and their performance over that period of time? Now, your investment strategy ultimately should be dictated by the goals that you have. For example, if you've got a long-term goal of wealth accumulation, your investment strategy may be tailored towards growth assets. So getting out into the share market, property, for example. If you've got a very short-term preference, once again, growth assets may be appealing. However, if you're more of a conservative investor and sort of can't tolerate the ups and downs of the share market, your investment strategy needs to be very defensive and conservative. So cash and fixed interest may be your preferred options there. So determining your investment strategy is a tricky one. You may need to reach out for help and support in order to put a plan together. However, a strategy such as a growth or a defensive one shouldn't be a set and forget one. It should be constantly monitored and reviewed over that period of time. Now, the final tip I've got for you is to essentially understand your investment options. Beginning with shares, it is definitely a growth asset that can rise and fall quite quickly. So it can be volatile. It's an asset that can potentially pay dividends back to your account. And those dividends, much like we talked about compounding earlier on, can be reinvested to buy more shares. So shares are a fantastic way to accumulate wealth over, I would consider, a long period of time. For those who would like exposure to the share market, but would like to reduce the risk of volatility somewhat, you can pick up what's called managed funds or ETFs, which is electronic traded funds, which is a similar investment but traded on the stock exchange. So managed funds are excellent to help with that diversification across multiple asset sectors, whether that be Australian shares, international shares, and even property and fixed interest and cash. So it has sort of the best of both worlds in one investment option. However, you need to keep in mind sort of ongoing fees and charges in relation to most managed funds. Now, for those more conservative, cash, fixed interest, simple term deposits are considered less volatile. However, the rates of return are considered a little bit more conservative and a little bit more reliable as well. So, if your goal is to accumulate a certain level of wealth in maybe a short period of time, it may not be achievable within defensive assets such as cash and fixed interest. So sort of understand the trade-off in relation to that. Other options will be obviously property. However, investing into direct property, it generally means that you need to take on some form of debt to buy in at such a high purchase price. Alternatively, you may get exposure into property-style managed funds where the buying price is a lot minimal. So that could be an option as well. So understanding investment options is very important to understand, the risks and disadvantages, and also the pros that go along with that as well. Now, investing can be an exciting journey and one that we encourage all our clients and even their children to start as soon as they can. And that could be through their teenage years, or their parents could start investing on behalf of their kids at a younger age, of course. We encourage to put forward a bit of a plan and understand what your goals and objectives are, and sort of know where the finish line is, and reward yourself and acknowledge those achievements. Now, investing can be difficult. There's a lot of information online that you can find, and there's a lot of conflicting and maybe biased pieces of advice as well, so be careful with that. If it's confusing and you find you trouble sort of putting forward your own plan, definitely go out and speak to a financial advisor or someone who's gone through the same process, maybe able to give you some hints and tips as well. Thanks for listening. I hope this information was of value.